Welcome to part 3 of tonight's program of the Opportunity Zones Meetup. Our topic for this evening is setting capital goals. We are now working our way through different steps in a process that will lead to a logical, rational outcome in setting a goal. And in this next section, we're going to talk about matching capital sources. So as we get into this is step 2 in a 10-step process. And in the prior one, we were talking about what do we need? And now the question is, who can supply what we need? And again, to differentiate between what is commonly done is I need to start my business, and it's assumption I'm going to write a check. I'm going to use cash for everything. I'm going to go to somebody who has cash, whether they care about me, know me, or anything else. I'm going to tell them I need cash, and then we're going to be disappointed most of the time because they don't care about what we're doing, even if they have the cash. And sometimes even people are talking to people with no money, which will never get anywhere anyway. But that being said, in the second stage, now that we've identified this potentially could be a very long list, highly described, highly specific list of resources we need to hit different milestones, who can give us that particular type of capital? So I'm going to talk about the 3 that I used in the illustration: cash, people, and equipment. Starting off with cash, cash is not the same. And this is hard because everybody goes, cash is cash. And you're going, yes, it is. It spends the same, but cash is only spent because somebody made a decision whether they're going to spend the money or not. And the decision is made by an individual, and everybody knows individuals are individuals, so they're all different. So some people have cash who are very visible, and this is where we tend to spend too much of our time because we know I have a venture capital firm. They are in the business of making that money available to startup businesses. You're a startup business, you say, they should give me money. Well, we skipped a number of steps getting to that last part. But the fact that you know they're there and they're in the business of making that money available doesn't mean they're going to give it to you. Actually, the statistics on raising money from a venture capitalist are far worse than raising from an angel investor. It's only like 1 in 2,500 pitches will receive money from a venture capitalist. They have a set number of criteria. They need a very high rate of return because it's perceived that their investments are all very, very high risk. And they're managing money for somebody else. They are working for the benefit of their investors, and they've promised their investors high rates of return. So they won't look at a small business that has no ability to scale. They won't look at a business that has a low profit margin. They have all these reasons to tell almost every business out there, no, you don't meet our criteria. So don't talk to a venture capitalist unless you happen to have a very unique business that may be filling a gap in the market with high scalability, high profitability in a very short period of time, because you won't meet their needs. Talking to them is a waste of your time. Other than that, you may get practice in pitching, or they may introduce you to someone who's more appropriate to you. But the fact they're visible and have money, they're in the business, doesn't mean they're going to give it to you. There are a lot of people out there who actually may want to give you the resources you're looking for, the cash that you want, but they're not as visible for one reason or another. It may be in a government program, like we mentioned earlier, that a lot of the federal agencies are now matching or supplementing private money with public money in order to improve the communities in which these projects exist. But right now, figuring out which agency it is, what program it's under, who to talk to, is its own set of time and money to just gather that information, and you still may find out that you don't particularly qualify for that particular program because you're in the wrong area, wrong time, they've exhausted their budget, or some other particular reason. So cash is cash, but as a resource, not everybody who has cash is going to match up with you at this point in time. And what we're trying to do here is we're trying to say, if you're going to look for cash that's in your profile, the capital you need, we want you looking in the right place. We haven't got into qualification yet. We haven't said, yes, we have two people with cash, one is better than another. We're simply saying there's a potential, a possibility that you may get this particular resource from this particular group. Now, today in opportunity zones, obviously, if we're only raising money into a fund, we have a limited number of people to talk to because they have to have capital gains. If they made their money somewhere else and it isn't a capital gain, they cannot invest into a fund and get a tax benefit. And again, if you're pitching only an opportunity zone fund, you haven't made a provision for non-opportunity zone money. A lot of the people you're going to talk to go, that's all very interesting, but I can't do anything for you. I've got $5 million, but you have no vehicle for me to give you that $5 million because you didn't set up a non-opportunity zone or a private placement to go alongside of your opportunity zone fund, and they basically can't play in this game. If you're looking for something that's not opportunity zone money, it obviously broadens the spectrum of things you can look at. Still in the cash zone, we're only talking about cash at this time. And there we have things that are complementing the same community. So we have things like PACE money, we have Jumpstart money, we may have local economic development money, we may have bonds or something from a municipality. There are tax credits for doing different things. And these can all be stacked on top of opportunity zone money to give you the total amount of cash that you need. And you may find along the way that as much as tax incentives create a reason for people to put money into a fund and make it available to you, that there is cash available from other sources with less work, less complexity, less time, and therefore your cost of raising that money is lower, and the price you're paying for the money may be lower. A lot of times you're seeing people come into a project, they say we're going to raise the down payment with opportunity zone money, give up equity as they're required to by the statute, and knowing that that's going to be expensive money, and then turn around and leverage that money through a bank or another program, 3 to 1, 4 to 1, even 5 to 1, and that money's cheaper because it's bank financing. It's not a share of future profits that would end up net being a much higher price of money. So we're thinking through this again, logically going, I know I need some cash, but I may not need everything that I need in cash. I may be able to get my other assets in a non-cash form, but when I do get to cash, I'm again delineating between sources of capital who have different motivation, different cost of money, different reasons to participate, and I'm trying to think through this in advance, because if this is the hardest type of capital to get, I want to reduce the amount of this so I can find other sources of capital that are easier to get than cash. So people, this is, we have not yet found a business that operates without people. The autonomous business is yet a thing of the future that we haven't created. But along the way, again, we ask the question, if you need somebody who's a vice president of sales, because you need a sales person with the skill and knowledge, there are people who have sales experience, and there's people who've never sold anything in their life. They're not the same person. At the same time, I could hire this person full boat, full scale, market value, with benefits at maximum cost, or I could hire them half-time, or I could put them on a quota tied to performance, so I'm not giving them a guaranteed salary. I've got them having to demonstrate value continuously through their performance. Or I could say this is a startup, or we're still a young company. What I'll do is, if you will take a cut in salary below your market value for a period of time, I'll give you equity in the company. And by doing that, you've raised money at that very point in time. Without going out to an angel and asking for money to go hire someone, you've convinced the person you actually need to come on board at a reduced rate or a deferred compensation, which is the same thing as if you had raised the money or borrowed the money to get to the same point. You're going to have to pay it sooner or later, but you have someone going at risk in the investment simply by deferring their compensation. we step down the ladder further. You go, well, I don't even need to have them on my staff. I need them kind of every now and then. So like we're doing in the Colorado Center for Innovation and Community Capital, every capital campaign will be under the guidance of a staffer who's a campaign manager, but each team will be consisting of a custom group of contractors that are hired as needed, when needed, that are fit to that particular project and fit to that specific type of need. So we're not sitting on thousands of people who are standing around waiting for us to give them a call and say, hey, we have a project now that fits up with you, and we're paying you a salary the whole time. We can never afford to do that and make this work. So everything is kind of on an on-call, standby basis, kind of like a volunteer fire department. Oh, we have a campaign. It's on the north side of town. We'll call the volunteer fire department from the north side of town to run in and help put the fire out. And then they go home back to their regular jobs, and that keeps our costs down for the community. We're doing the same thing as we run capital campaigns. You need to do the same thing when you're assessing your people needs in terms of what skills do they have, what skills do they have that you don't want, when are they overskilled, and fit this to the purpose. You're finding that asset management, resource management is its own science, art, and everything else. And then trying to get it from somebody else is the art of raising capital. The last one on this list is equipment. Not everyone has equipment. So if you need a forklift and you go to somebody you know, you go, hey, can I borrow your forklift? And they go, I don't have a forklift. I can't help you with that. Or they go, I don't have a forklift, I have a bulldozer. Do you want one of those? No, that doesn't fit either. And we're going through the same kind of analysis like we did with people. What kind of equipment is it? What is it? Because what we're going to find as we get further into this process is we're going to identify people who have the asset we need, who want to give it to us because they have a reason to give it to us, not just a return on investment, but another reason beyond return on investment. And we want to know who they are, because if we go to them directly, we may get this cheaper, better, quicker, and we also don't have to go through the full exercise of raising capital through an Opportunity Zone fund. We're not denigrating the Opportunity Zone fund because they're being incentivized to make the money available. But if they say, hey, I'm only investing in your fund if you can guarantee me a 25% annualized ROI, a lot of businesses won't be able to afford that. It becomes a non-accessible area of cash because it's too expensive. So what if I can get, if I had received that money from an Opportunity Zone investor and I was going to use it to buy a forklift, and I can call a friend of mine who says, yeah, we're only using it because we're a seasonal agricultural station, and we only use it during the summer to move pallets across the warehouse. The rest of the winter, those things are pretty much sitting idle. You want to borrow it from me? I'll rent it to you for a discount or something. They're making more money by putting that equipment to use when otherwise it's sitting idle, and you got it for a fraction of the price, which means your cost of operations is down, and therefore you're more likely to be successful, and there'll be more profits left over for your investors. So it goes together. The thing that you're going to end up with at this point is you're going to have what we're calling a catalog of capital sources. This one is still a little high level, meaning that we know we need a kind of capital. We've identified places where that capital is available. It may not be willing to give it to us. It may not be at the price point we want. We may not be comfortable with the person, or it's too complex of a transaction to put together. But now in our head, knowing that we need this kind of stuff, and there are people who have that kind of stuff, whether it's cash or people or equipment or facilities or land or buildings or intellectual property or social contacts, we're starting to look at the world a little bit differently. And this is very helpful because the people who hold those assets each have a different reason why they may or may not help you. And as we get later into this process, we're going to be profiling people who want to give you that asset in their own self-interest. And if they want to give it to you, then it changes the nature of raising capital from pursuing people relentlessly and hounding them and stalking them and pitching them and getting no result, to actual a joint venture, a form of collaboration, a positive form of relationship where everybody's getting what they want out of the deal and everybody's benefiting from the deal. And it changes the nature of raising capital immensely. So you'll have this list of sources that you've identified. Again, it's high level. You may have already identified somebody, oh, I know exactly who to talk to get that forklift. Great, put them in the catalog. You may also go, I need a forklift. I know people sell forklifts. I know they lease forklifts. I know people might share a forklift. I'll put them in the catalog if I know who they are, or I'm just going to create a category. But now we're thinking outside of the box of cash is cash is cash, which tends to mess up your thinking and narrow your choices and your options when you go to raise the capital you need. Any questions on this? Trace, you want to go through the exercise again?
Sure.
Okay, so we identified a number of milestones. 10 years down the road, you'd like to have $10 million of money under management. You're going to have a number of staff, somebody overseeing the staff. You're going to need some better software. You said a little more automation, a little less manual things. You've decided you're not going to give them Ferraris, so that's off the list. And but generally, it's a service agency managing money. There's a number of people that have to be involved because you need to get the money out there in your sales, and then you need to manage it to make sure nobody basically disappears with too much money or goes down with the money. Fraud, other things. So at this point, though, now you're saying, well, what are the resources you need to fulfill those goals? You're going to need people. You've named 10, 11, 12, 10 managers, a super manager, a couple salespeople. You've got the executives who have to sit over this and make sure everything's all working together. So people is going to be your primary resource. Yep. Now on the software, you could build it yourself. Yep. You could contract it out to someone. Yep. You could find it off the shelf where somebody's already built it and you can buy it for a fraction of that, and you don't have to then hire 3 more people to do coding and so forth and deal with the various of that. I talked to 2 companies in the last week. We're going to build our own software, and I immediately start feeling pain for these projects because they made themselves a technology company when they were a service company, and now they need special talents at higher cost. If they can find it from another source that's more reliable, more stable, lower cost, that's a better use of the assets. And investors love prudent asset management because it means you're looking out for their investment and it's going to lead to higher profits, which should lead to higher distributions. So we've got that with the software. Those would be 2 key assets that you're going to be working, primarily people, and then tools to help those people be more efficient in what they're doing and keep better attention on what's taking place. Anything else you can think of now that we're looking backwards?
Some of the larger factors will have their own credit databases that they've been building for years and years and years. So where that becomes an asset in and of itself.
Right.
Business.
So when somebody comes to you and says, I would like for you to factor my money for me, you go, 1 moment please. You can go in the back room, you pop up the database. Yep. This guy's got 5 black flags next to his name. You come back out, I'm sorry, I think we put our last money out last week. Sure. We can't help you right now. But that data is very important because it helped you qualify somebody, avoid a potential problem in the future. And even if you do ultimately get all your money back, any time you expend in collecting the money beyond a normal automatic payment is all cutting into your margins. It's going to take up time and money, and you still may not get all your money back, which contributes to a loss. So so now you're going, okay, and this is why we like this process, because as you're thinking through this, you're going, I don't have to have that database, that credit bureau data, but if I'm now looking at my new size and scale and I'm looking at the potential losses I might have, and I look at the cost of getting this relative to my potential decrease in losses, I'm doing an internal investment analysis on what I may want to do. And you may say, I'm going to go back to my needs list. I'm going to write in a database and what has to go along with that, and the cost of capturing and maintaining that data. And then you're going to come back to, where can I get that from? One, you can create it on your own, or you may find somebody who's in the industry says, I'll let you look at my list and I'll charge you a small fee for it. And now you're doing a comparison again on what's available to you and where is it from. Where you could say, or we could take what we call the simple approach. I need $5 million. I'm going to go out and create a data processing center. I'm going to hire my own people. We're going to survey everybody on the street, whether they're ever going to factor money or not. And we're going to tabulate all that data. The next time somebody walks in the door, we'll know immediately what their credit score is. And we can say, you know, whether you can come in or not. And as ludicrous as that sounds, I have seen proposals worse than that, you know, come through where you're like, that doesn't seem very efficient to me. Maybe it could be done better. But this is what we're getting to, is now we've got two intersections taking place. What do you need? Who might provide what you need? And we're going to talk about bringing these two together in capital goals in the next section. So we're going to take another break at this time. So take a couple.